Hello, good afternoon. My name is Richard Monroso. Today we'll be talking about how personal credit can impact business credit and how you're able to build your business credit as well. My name is Richard Monroso. I'm a small business specialist. I help out clients in different stages of their life. If you're starting your business, I'll be able to help you out with that. If you are already established your business, I'll be able to take care of you. Or maybe you're into retiring and maybe selling your business or giving your business to your son, your kids, your daughter. Anyone will be able to take care of you with that. Whatever your vision is, we'll make it a reality. This is my information below. I cover the whole state of Arizona. There's really not a specific area that I do help out anyone specific. I am mostly on the west side though, but I'm able to go anywhere in the state. And if you have any questions, please feel free to connect with me, and we can set up a time so we can go over your goals and see how we can align your goals with your vision as well. Understanding credit types. We will first start out by differentiating between credit types. Let's explore how your personal credit can impact your business credit. Why is credit reporting important to my business? As an entrepreneur, your personal and business credit histories can create opportunities or limit them. When you apply for financing, financial institutions and suppliers will review your business credit history and may review your personal credit history as well. Credit history helps creditors decide whether to extend financing and, if granted, on what terms. To effectively manage debts and obligations to financial institutions and trade creditors, you should understand that business lenders may know about your personal debt. Unpaid personal debt can lead to a business loan denial. Healthy businesses and personal credit histories help grow and sustain a healthy business. What is a personal credit score? Your personal credit score is also known as a consumer credit score. It is based on the information on your personal credit report. Your credit score is a number that helps lenders and creditors determine your risk, that is, the risk of default. It is common for lenders to use credit scores to help them make loan decisions. Lenders may use one or more credit scores to help make a lending decision, and these scores may predict different types of risk. Lenders may generate the scores themselves based on account history, or also it's calculated by another company. Credit scores frequently are used generally by two score modeling companies, FICO and Vantage Score. FICO and Vantage Score are calculated in different ways, but both are on the same scale. They are between 300, and the max credit score that people can have is 850, which is a fun fact. And it's okay no matter what stage in life you are in, as long as you know that you want to, what your goals are, you can align them so they can be where you want to be at. And if you need help with getting a better FICO, or want to understand a little bit more, you can always reach out and we can see how we can help out as well. Components that impact your personal credit score may include payment history, outstanding debt, especially the credit usage that you are offered in revolving credit, like in credit cards. So they'll look at how much credit you've used for your credit lines for each of your credit cards, the length of credit history, how often you apply for credit, what credit products you're usually using. And also, one thing that's very important is not to run your credit frequently. People don't want to see that you're consistently running your credit, because sometimes it may seem bad to lenders, and they'll ask you why you run your credit so many times. Generally, a higher credit score means that you are likely to be in lower risk for a lender, or in other words, a good borrower. If you have a low credit score, it may impact your ability to obtain credit, and the terms of or interest rate that you have to pay them may be less favorable. Credit for your business. Credit is the ability to borrow money based on the promise that you will pay it back. Some examples include car loans, credit cards, small business loans, and mortgages. Let's look at some of the following questions. Have you applied for a business loan or lines of credit in the past? What information and documentation did the lender obtain or request from you during the loan application process? Did the lender tell you if he or she would need to check your credit history? Business credit reporting. We'll be talking about the difference between credit types and how your personal credit can impact your business credit. Now let's look at the impact of business credit reporting might have on your business. Personal versus business credit reports. While business credit reports are not all the same, they all provide the following information: your business identifying information, business credit history, business ground, registration and financial information, public record information. Unlike personal credit reports, business credit reports are generally available to the public. This means that potential customers, partners, suppliers can purchase your business credit report from business credit reporting agencies, but are not required to provide your business with a free business credit report upon your request. Everything's public regarding a business. People can see when you created your business, how long you've been in business for. That's why your business credit is public as well, because everyone's able to look at that information. The major players in business reporting. There are three well-known business credit bureaus that are Dun& Bradstreet, Equifax Business, and Experian Business. Many of the information that they collect may overlap, and Dun& Bradstreet focuses solely on business credit with an emphasis on how the business interacts with its vendors and suppliers, known as trade credit performance. Equifax Business complies with business credit reports with a focus on small businesses, experiences with business lines of credit and loans from banks and non-banks. Experian Business focus on bank and non-bank lender data, vendor and supplier data, and information in public records. Establishing business credit. Why should I establish business credit? Business credit reports help entities receiving the report determine whether and under what terms and criteria to work with your business. A good business credit history might give you a competitive advantage. Remember, many business credit reports are available to the public. A strong business credit report can increase your company's business prospects. Support businesses' growth and sustainability. Having strong personal and business credit histories can support the growth and sustainability of an emerging small business. For example, if you have a strong credit history, it allows access to financing to start or expand a business, enables you to buy another business, finance materials and inventory, allows investment in equipment, materials, vehicles, and other market opportunities. Facilities borrowing money to help address working capital shortfalls. For example, if your business might need a line of credit to purchase equipment, inventory for an upcoming sale season, or a large order that you may have from a client. You may want to check out the business credit report of your suppliers, shipping companies, or customers. This can provide you with valuable information, yet many small business owners don't run credit reports on potential business partners. How to establish business credit. This is this slide I would emphasize this so much. If you're an entrepreneur and you don't know where to start, right? You're like, you know what? I'm thinking about doing this, but I don't know when to start it, right? One thing that I would recommend you that I've learned from my clients that everything that they have in common, one if it's one thing, it's that everyone's a risk taker. If you're a business owner, I encourage you to just start your business. You don't know where to go? Great. This is what you're going to be able to do. You're going to need an employer identification number. How are you going to get that? You're going to go to the IRS and establish your EIN. You're going to be able to build your business credit report. And also, if you wish to do business with the US government, you should do a Dun and Bradstreet number. You can do that through the DMB. So you go to www.dmb.com and you could register your DUNS number for free. Next, you already have open credit accounts or trade credit for your business. Let's find out how if you already have business credit history by searching your company name on the websites of each business credit reporting agency if your business is listed. If your business does not have a listing with the business credit reporting agencies, ask your lenders, suppliers, and vendors if they will start reporting on the business credit reporting. Great places to establish credit is a bank. You can get a business credit card. That's the easiest way how you can start your business credit. Keep a day job if you like, your daily job that you have, and then you can still get a business credit card. And the biggest importance of getting a business credit card, let's say that you need to buy things. Instead of using your personal credit card, you can use your business credit card. And while you use your business credit card, it won't reflect on your personal credit bureau as long as you're in good standing. You can also this will help you a lot because you'll have net 30 accounts. Many vendors don't pay you back in 30 days. So what you can do is sustain yourself within those first 30 days with no interest by using a business credit card. And also this can report on your on-time payments and credit reporting agencies. Many don't check personal credit reports, though they may. Some require the buyer to make several on-time payments before they extend net 30 terms. Once you have records established at one or more of the business credit reporting agencies, you can build your business credit history by updating or correcting your information. Best practices for strong business credit. Pay your loans, bills, and taxes on time. A strong payment history shows lenders that your business can be trusted to manage credit well. Paying taxes on time helps you avoid liens or judgments, interest, and penalties. Late payments can be an indicator that a business is having cash flow issues. Take take a couple minutes to take any takeaways from this. Make sure your business is visible. Lenders, customers, and other businesses want to be assured that you are known and trusted in the community. You're becoming visible by having an EIN, which is an employer identification number, phone number, legal address, and digital presence. How do you maintain a good relationship with suppliers and vendors? It is important to maintain a good relationship, having a good track of record of paying other businesses that you will work with on time, and this will help you strengthen your business credit history. Why do you need to monitor your personal and business credit histories? This is important because you need to know what's being reported to consumer and business credit reporting agencies, and you need to dispute if anything is inaccurate. Why is it important to separate personal and business finances? Avoid using your personal assets and finances to support your business. Do not commingle business and personal finances. Seek advice from professionals such as insurance agents, accountants, lawyers to limit your personal liability for your business activity. Obtain credit accounts when needed in the name of your business. Credit worthiness. We explore the impact of business credit reporting on your business in the three well-known credit business reporting agencies. Next, we will discuss how lenders evaluate your creditworthiness and look a little more closely on how that ties together with the reporting agencies. The 5 C's of credit. These are the sorry. These principles are known as the 5 C's: capacity, collateral, credit history, conditions, and character. They're used to determine the overall creditworthiness of potential borrowers. Perfect. Capacity is the cash flow that the business needs to demonstrate it can repay a loan. Lenders are always going to want to know your revenue and will use it to repay the loan, and whether those documented, if the numbers that you give them is documented in your financial statement and tax returns. Collateral is a form of security you provide the lender by pledging an asset you own or your business owns, such as your equipment, inventory, and agreeing it will be the source of repayment if you cannot repay the loan. When you default on a loan, it involves collateral. The lender has the right to foreclose or repossess the assets used as collateral. Credit history refers to the credit performance of the business owners, and the business lenders evaluate information obtained from the business, consumer credit bureaus, as well as internal financial institution information. They consider information such as credit scores, inquiries, and credit utilization, as well as delinquency in some public records. Conditions involve a variety of qualitative and quantitative measures, including the conditions of the loan, how you will use the money to expand or purchase equipment, inventory. Character refers to mostly qualitative measures such as your personal integrity, business reputation, and references provided by your customers. And character is also reflected in your business history and your business credit history. Different lenders, different priorities. The blue represents lender A and green represents lender B. Gray areas are components that are not used by either lender in this example, but may be used by other lenders. Lenders have different priorities, which may be influenced by the types of loans and credits they offer, the amounts of credit to be extended, and the type of businesses they typically serve. Big and small banks, credit unions, and other lenders, including certified community development financial institutions and online lenders, have slightly different lending priorities and policies for credit approval. In this scenario, with lender A, the lender is considering the 5 C's and emphasizing personal credit and collateral. However, lender B may focus on more on the business. The key is to find out what your lender looks for. So plan ahead, meet with a loan officer, meet with a banker, see what options they give you so you can compare and contrast and see what option is the best for you. One thing is that if you are declined for a loan, know that there are other options. Understand first why your loan was declined, time in business, it may be business credits, slow payments to vendors. If these are if anything on this is incorrect, you need to contact the credit agency. Each agency has a process for disputing items on your report. You can also consider alternative forms of financing, which we'll cover at the end of the presentation. What's a good business credit score? A strong business credit score can help you get favorable payment terms from any of your business suppliers. Factors that impact your business credit score very much like personal. Time in business, payment history, credit mix, credit utilization ratio, mistakes on your credit report. Need additional assistance? You can connect with a business banker at US Bank, your CPA, your economic development department, your local chamber, business industry organization, your local SCORE chapter, and your business mentor as well. Can you think of some other resources that we haven't covered today? If you do, um, it'll be a great resource. Anyone that you can pick your brain or pick their brain from would be great, so they can guide you as well. How lenders evaluate your credit worthiness and credit options. Thank you again, and my name is Richard Monteroso.